Hello everyone, welcome back. Returning to our analysis, have you ever stared at a trading chart and felt like, wow, am I trying to decode an alien language? It can be extremely confusing. But today, we are going to deal with that chaos together and turn the market's unpredictable ups and downs into a picture that is clear and logical. The secret lies in a very powerful tool that we are about to explore right now. The biggest question here is, how can we truly understand that chart? As you know, for beginners, a price chart can look like a complete mess. Green and red candlesticks keep jumping up and down constantly. This kind of noise can easily ruin anyone's trading strategy. But don't worry, there is definitely a core solution that helps us filter out that noise and find very clear signals. To do that, today we will quickly go through a 5-step roadmap. First, filtering out market noise. Second, identifying the trend. Third, combining two moving averages. Fourth, support and resistance. And finally, recognizing reversal points. Okay, let's begin with the first part, filtering out market noise. Let's get familiar with today's hero. That amazing tool is the moving average, often abbreviated as MA. Simply put, its job is to calculate the average closing price of an asset over a certain period of time. Just imagine it like an iron. It takes all the rough wrinkles, the sharp daily price fluctuations, and smooths them into a cleaner, more flowing curve. Thanks to that, we can see the bigger picture much more easily. Now, you can set this MA to many different periods, but the most popular classic numbers in the market are still 20, 50, 100, and 200. The core rule here is extremely easy to remember. Shorter periods like 20 or 50 help you track short-term trends, while larger numbers like 200 act as a very reliable measure of the long-term trend. Now let's move to the second part, identifying the trend. We will now see how to apply these smooth lines in practice to understand where the market is going. Basically, the position of the price compared to the MA tells you almost everything. It's like standing on an escalator. If the price consistently stays above the MA, the escalator is moving upward. That is exactly an uptrend. At this point, you should mainly focus on buying opportunities. On the other hand, if the price falls below the MA, the escalator is moving downward, signaling a clear downtrend. In that case, the wiser move is to prioritize selling opportunities. Very logical, right? But in reality, the market does not always behave neatly in one direction. There will be times when the price keeps crossing above and below the MA again and again, just like a swinging pendulum. When you see the market in this sideways, choppy, pendulum-like state, the most sincere advice is to take a step back, stay out, protect your capital, and wait until a truly clear new trend appears. Next is part 3, combining two moving averages. This is truly a powerful technique drawn from more advanced materials to improve your analytical ability. Instead of using just one single line, we combine two moving averages. To get a complete view, the first step is to look at the short-term MA, for example, the 2-0 period MA, to see which side the market's current momentum is leaning toward. The second step is to add a longer-term MA, such as the 200 period MA, onto the chart. This 200 period line acts like a compass, helping you confirm the main long-term trend of the entire market. You know, this combination really solves a trap that many people often fall into. For example, suppose the price suddenly drops below the 2-0 period MA, signaling a short-term correction, but the price still remains completely above the 200 period MA. What does that mean? It means the main trend, the long-term trend, is still upward. If you rush to place a sell order at that moment, you are actually putting yourself at great risk because you are trading against the main current. That is also why our source material emphasizes a very interesting point. Using two moving averages will not necessarily give you better trades, but it will help you avoid bad trades. Remember, this method is not magic that helps you win every battle. On the contrary, it is a strong shield that protects you from jumping into foolish trades. Okay, now we move to part 4, support and resistance. Let's see how we can change our perspective on these lines to find entry points. Actually, the MA is not only used to show direction, it can also act as an invisible boundary that moves automatically and follows the price. In an uptrend, the MA can become a very solid floor of support. Buyers often wait and enter right there because they see the price pulling back to an attractive level. Every time the price falls, touches this line, and then bounces back up, that can be an ideal buying entry. Similarly, in a downtrend, the MA acts like a ceiling of resistance. It can signal excellent selling points whenever the price rebounds, touches the ceiling, and gets pushed back down. And finally, Part 5, Recognizing Reversal Points. This is where we learn how to know when a trend has truly come to an end. Usually, if you only look at the price crossing the MA, you can easily be fooled by false signals, also known as fakeouts. A much safer method is to patiently wait for the two moving averages themselves to cross each other. When the short-term MA crosses above the long-term MA, that is a very strong signal confirming that the trend has shifted from bearish to bullish. Conversely, if the short-term MA crosses below the long-term MA, it is loudly signaling that the market has completely fallen into the hands of the sellers. Waiting for this crossover really helps you filter out noise very effectively. So, we have gone through quite an interesting journey together, haven't we? From using the MA like an iron to smooth out noisy price fluctuations, to using the long-term MA as a compass for trend direction, and then using these invisible floors and ceilings as support and resistance. The biggest question for you now is this. The next time you open a trading chart, how will you look at it? Will you continue to let yourself get caught up in that chaotic mess? Or will you immediately apply these highly logical tools to truly take control of your investment decisions? I hope today's analysis has brought you valuable strategies. Try applying them to your own charts and feel the difference for yourself. Thank you for joining me.